The statement of cash flows shows financial statement users where cash came from and where it went. It is the only one of the general purpose financial statements that is not prepared based on accrual accounting concepts. To review, with accrual accounting, we recognize revenue when earned based on the revenue recognition criteria, and that criteria specifies that revenue is recognized on the income statement when the earnings process is complete and the amount and timing of a receivable can be reasonably determined. And GAAP requires that expense be recognized when incurred, which is based on the matching principle. Alternatively, with cash basis accounting, we're going to recognize revenue when cash is received. So the linkage between performing a service and earning the revenue and cash flow is severed. So notice that the timing of the cash being received, this could be prior to accrual recognition of revenue at the same time, if you think of a cash sale, or after an accrual recognition of revenue, if we think about a sale and a receivable. And with cash basis accounting, we recognize expense when cash is paid. This graphic illustrates that for the business, there are cash inflows that are constantly coming into the business. We'll categorize those inflows and the outflows in three categories: operating, investing, and financing. Each of those categories results in cash going into the business and cash going out of the business. A statement of cash flows organizes cash inflows and outflows into three sections or categories. Those are operating activities, investing activities, and financing activities. Operating activities convert accrual-based net income to cash flows. Notice that Yum's operating activities section begins with net income. This is referred to as the indirect method. So we take the bottom line off the accrual-based income statement and we adjust that to a cash flow amount. Notice that the net cash provided by Yum's operating activities has significant positive numbers for all three of the years shown. This means that the company's operations, what they're in business to do with Yum, that's their restaurants, are generating cash flow. And this is what you would expect to see in a company that's healthy and growing. The second section in a statement of cash flows is the operating activities section. What this section shows are cash inflows and outflows from the business related to investments in non-current assets. Since Yum's operating cash flows are generating large positive amounts of cash, they're able to invest extensively in each of the 3 years that we're looking at in their non-current assets. The third category on a statement of cash flows are the financing activities. This relates to cash inflows and outflows related to non-current liabilities and stockholders' equity. In a statement of cash flows, this section acts as a plug section. Because Yum is generating positive cash flows from operations, they have cash left over after they've invested in the business. So you can see by looking at the statement of cash flows financing activities section that Yum has chosen to flow a lot of this excess cash out to its shareholders. They have huge amounts for repurchases of common stock, and they're also paying a fairly healthy dividend. At the bottom of this page, the statement of cash flows wraps up, and we have the change in cash for the current year being added to the beginning of the year balance, and that explains how cash went from the beginning balance to the bottom line on the statement of cash flows, which is cash at the end of the year. What this statement does for a financial statement user is to tie together and say, here's what caused cash on the balance sheet to change. Now let's talk about preparing the statement of cash flows. The starting point for the statement of cash flows is the operating activities section. Here we're going to convert net income to a cash flow. So we'll use changes in current assets, current liabilities, and non-cash items such as depreciation or gains or losses to make those conversions. There are two ways to prepare the operating activities section of the statement of cash flows. They are the direct and indirect method. Both approaches give the same cash flow from operations. They just derive that number using different approaches. So starting with the direct method, the graphic below shows for categories of revenue and expense. On an accrual basis, as we think about revenue, it's sales based on the revenue recognition criteria. And the cash flow that we want is cash collected from customers. For expenses, an example would be cost of goods sold, which is the accrual concept of the cost of inventory used up in the production of sales. On a cash basis, we would want cash paid to vendors. In the final two sections of the statement of cash flows, investing activities and financing activities, we tend to have fewer transactions for larger dollar amounts. So in investing activities, we're looking at the cash flows that are from non-current assets. So sales of property, plant, and equipment, for example, would result in an inflow of cash to the company, whereas purchasing property, plant, and equipment would use cash. In the financing activities section, we have cash flows from transactions with non-current creditors and with shareholders. So a cash inflow would be from the company issuing debt or issuing additional shares of common stock, and a cash outflow would be paying down that debt or making a distribution to the owners in terms of a dividend or a repurchase of treasury stock. For the comparison of GAAP to IFRS, there are several interesting differences related to the statement of cash flows. One is that IFRS allows companies to classify interest paid to creditors and dividends paid to shareholders in the same section of the statement of cash flows. Notice with GAAP, that's not true. Interest, because it's an expense on the income statement, would be an operating cash flow, whereas dividends paid out to shareholders are considered a financing activity. So under IFRS, companies can classify those flows in similar sections of the statement of cash flows. They merely have to be consistent from one period to the next.